Have you ever wondered what actually happened in 2008? One minute, the economy seemed fine, and the next, it felt like the entire world was on the brink of collapse. It's a story of greed, complexity, and a house of cards that came tumbling down. Today, we're going to break down the 2008 financial crisis in a way that everyone can understand. It all started with a simple, powerful idea: the American dream of owning a home. In the early 2000s, interest rates were incredibly low. This made borrowing money cheap, encouraging more people to buy houses. Banks and mortgage lenders saw a golden opportunity. They started offering loans to just about anyone, even those with poor credit histories and unstable incomes. These were called subprime mortgages. Now, you might be thinking, isn't that risky for the lenders? And you'd be right. But they had a clever and ultimately dangerous way to manage that risk. Instead of holding onto these risky mortgages, they bundled them together. Imagine making a fruit salad. You take thousands of different mortgages, some good, some okay, and a lot of those risky subprime ones, and you mix them all up. This fruit salad of debt was called a mortgage-backed security, or MBS. Financial wizards on Wall Street then took this a step further. They sliced these MBS bundles into different pieces, like layers of a cake, called tranches. The top layers were considered the safest and received the highest credit ratings, a tripola from rating agencies. These agencies were supposed to be the impartial referees, but they gave their stamp of approval, making these products seem as safe as government bonds. The bottom layers were riskier, but they offered higher returns. These more complex structures were called collateralized debt obligations, or CDOs. This is where it gets really interesting. These CDOs were sold to investors all over the world, pension funds, other banks, even cities and towns. Everyone wanted a piece of the American housing market, which seemed like it could only go up. The demand for these CDOs was so high that it created a huge appetite for more mortgages to be created, fueling the lending frenzy even more. Lenders were incentivized to sign up as many people as possible, often with little to no down payment and teaser rates that would later balloon into unaffordable payments. This flood of easy money created a massive housing bubble. With so many people able to get loans, the demand for houses skyrocketed and prices went through the roof. People were buying properties not to live in, but to flip for a quick profit. It felt like a party that would never end. But all bubbles eventually pop. By 2006 and 2007, things started to change. Those low introductory interest rates on the subprime mortgages began to reset to much higher rates. Suddenly, homeowners who were barely scraping by found their monthly payments jumping dramatically. Many couldn't afford them. At the same time, the overconstruction of new homes led to a surplus. With more houses than buyers, prices started to fall. This created a devastating spiral. People's mortgages were now underwater, meaning they owed more on their loan than their house was actually worth. If they couldn't pay and they couldn't sell, the only option left was foreclosure. As millions of people defaulted on their loans, those mortgage-backed securities and CEOs, once seen as golden tickets, started to turn toxic. Remember that fruit salad? Now it was full of rotten fruit. The value of these securities plummeted. But who owned them? Everyone. Banks, investment firms, and institutions across the globe suddenly realized their balance sheets were filled with worthless assets. The problem was, the system had become so complex and interconnected that no one knew exactly how exposed anyone else was. It was a giant web of risk, and trust between banks evaporated overnight. Banks stopped lending to each other. Credit, the lifeblood of the modern economy, froze solid. This is what we call a credit crunch. Without credit, businesses can't pay their suppliers or employees, and the entire economy grinds to a halt. The panic reached its peak in September 2008. Bear Stearns, a major investment bank, had already been bailed out earlier in the year. But then came the big one, Lehman Brothers. Lehman was a 158-year-old institution, a titan of Wall Street. It was heavily invested in these toxic assets. When it became clear they were going to fail, the US government made a fateful decision. They let Lehman Brothers collapse and file for bankruptcy. The shockwave was instantaneous and global. It signaled that no institution was too big to fail. Panic swept through the financial markets. The Dow Jones Industrial Average had its biggest single-day point drop in history. AIG, the world's largest insurance company, was on the verge of collapse because it had insured trillions of dollars worth of these toxic assets through instruments called credit default swaps. Fearing a complete meltdown of the entire global financial system, the government was forced to step in with a massive, controversial bailout of AIG and other major banks. The fallout from this financial crisis spilled over into the real economy, what we call Main Street. The credit freeze meant small businesses couldn't get loans, leading to closures and layoffs. Consumer spending dried up as people lost their jobs, their homes, and their life savings. The US fell into a deep recession, and because the financial system is global, the crisis spread like a virus around the world, triggering a global recession. The road to recovery was long and painful. Governments around the world implemented massive stimulus packages and new regulations. Like the Dodd-Frank Act in the US, designed to prevent a crisis of this magnitude from ever happening again. These new rules aimed to increase transparency, regulate complex financial products, and ensure banks held more capital to absorb potential losses. So, to recap, it began with a housing boom fueled by cheap credit and risky subprime loans. Wall Street packaged these loans into complex, supposedly safe investments that were sold globally. When the housing bubble popped and homeowners defaulted, these investments became worthless, causing major financial institutions to fail. The collapse of Lehman Brothers triggered a panic that froze the credit markets, leading to a severe global recession. The 2008 financial crisis serves as a powerful reminder of how interconnected our world is, and how quickly things can unravel when risk is misunderstood and greed goes unchecked. It changed the world of finance forever, and its effects are still felt to this day. I hope this breakdown helped you understand this pivotal moment in modern history. It's a complex topic, but at its core, it's a human story about dreams, risk, and consequences. If you found this video helpful, please hit that like button and subscribe to our channel for more deep dives into the events that shape our world. Let us know in the comments what other topics you'd like us to explain. Thanks for watching, and we'll see you in the next video.